Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have Tony Busseri, the CEO of Route1. Route1 trades on the TSX Venture Exchange under the symbol ROI and in the US under ROI-UF. The company is trading at 62 cents with roughly 40 million shares outstanding, or about a $25 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks, Trevor. Tony, we just saw you release your financials yesterday. You've given us a presentation in the past, so we're going to completely bypass that. We're just going to get into sort of a Q&A. But before we get into that, maybe just refresh everybody's memory. What does Route1 do?
Yeah, thanks, Paul and Trevor. And good morning, or good, I guess it's good afternoon for everyone unless you're in Hawaii. Route1 is a company that goes to market delivering exceptional outcomes for its clients using their data. And simply put, we're building safer, smarter communities. We have 3 or 4 pillars that we like to talk about that help us deliver that for our clients. One is our data security division, our area of expertise, and our flagship technology in that area is MobiKey. Work from home or teleworking technology, SaaS-based model that allows you to access your desktop, whether it's a physical or virtual machine, while you're mobile on any device. It's a highly secure technology used by a number of different groups within the U.S. Department of Defense, and has done quite well during the global pandemic as a technology of choice for very secure clients. The second pillar for us relates to our advanced analytics or data analytics arena. And there we're using, again, technology to capture data, and that data then allows parties to make decisions with it. The offering I would highlight in this area is license plate recognition technology, where we partnered up with Genetec to deliver their AutoView license plate recognition technology to the marketplace in 2 primary areas. One is for parking lot operators and attendants. It allows them to deliver a better outcome for their users, whether that's an individual that's just parking at a municipal lot or it's a student going to class. It also helps them to be more profitable and get better utilization out of the scarce resource, which is blacktop for them. The second group would be law enforcement, and that moves everything from the meter person who gives you tickets for parking too long in spaces to police that use it to capture plates for the security of a community, whether there's an Amber Alert out, warrant for arrest of a driver of a particular vehicle. Our LPR technology is a central theme to the concept of providing smarter, safer communities. And whatever side of the equation you fall on with some of the social changes going on and how budgets are allocated, I think it's safe to assume that policing is going to be altered and changed. And again, without making a political statement, I think we all believe in safer, more secure communities. I think we would all agree that data is not biased or prejudicial. Data is just simply facts that are being used for the stakeholders within the community. Our third pillar really goes to the visualization of the information. If you're securing it and analyzing it, you certainly want to capture the profit associated with the visualization aspect. And in this case, we resell others' technology. We resell Panasonic or Dell or GTAC principally, as well as Zebra. They're rugged devices that are used by our clients in the field, whether it's fire or police, whether it's a technician on an oil rig. You can go on to the use cases, but in all those scenarios, data is important. Data needs to be interpreted and used, and then visualized so the action can be taken. We do have a fourth pillar to our business, which goes to our engineering and networking capabilities. But it's more of on a case-by-case basis. We bring that pillar to play. But to summarize, outcome-based company that's not pushing a product or a service or a solution. What we're doing is addressing a need of a client and providing a sustainable, economical way for them to affect it and a better outcome. Thanks, Paul.
Perfect. Okay, so why don't we jump right into it? You yesterday you announced financials. If I remember correctly, record numbers in terms of top line. You had the growth in your gross profit as well. Maybe just give us a sense of what happened in 2020 to get to increase revenues like that.
Yeah, I mean, generally you're seeing 20 to 25% growth in revenue, GP, and EBITDA. We'll talk about a couple items below the EBITDA line here in a second. But I mean, that growth is attributable to a couple things. One, the MobiKEY technology during the global pandemic led to a number of sales, which was great. And then the second part of that relates to the new integrated business model. So when we have a client that may want a rugged device, it's allowing us to have a discussion with them around body-worn cameras and LPR, etc. So it's that integrated model, what I call using transactional-based business as the Trojan horse to sell more sustainable and recurring revenue and gross profit. So 29.7 million of revenue, up from 24, EBITDA 2.46 million, up from 1.9 million. So quite excited about what that meant for us as we move through the course of the year. I guess our net income was impacted, and I'm not sure if this has been a influencer to the trading over the last 48 hours, but we had disclosed back in Q3 and then in late December a couple items that I thought the market was well in tune with. One, unfortunately, during the third quarter, a Turkish group representing a healthcare network out of Tennessee fraudulently acquired around $600,000 Canadian worth of rugged devices that the FBI and local agencies then provide us a lot of support on. And we were unable to recover them before those goods were left to the Middle East. That all being said, as we said historically, we are working with our insurance company about getting fully funded or refunded on that. We felt the prudent thing to do would be to take the accounting charge during the third quarter of 2020. Our auditors felt that was a prudent thing to do too. And we hope over the next 60 or 90 days to give a very positive update around the discussions we're having with our carrier. The second thing is that the lawsuit, the litigation we had to launch back in 2017 with AirWatch, we had suggested they were infringing on one of our core patents here in the US. And we had been quite successful with that litigation up until late 19, early 20, where they had switched out judges. I didn't know you could do it using a hockey metaphor. They went from like clearly the third line center and they brought out Austin Matthews, if you're a Maple Leafs fan, to jump on the ice here. I guess ultimately they felt that the docket was filled with this particular judge. They brought in an appellate court judge and we got an adverse ruling. As a result of that adverse ruling, it put us in a negative position with a similar piece of litigation we had against AirWatch in Canada. And ultimately we resolved that. The court in the US had ordered us to repay AirWatch for some of their legal expenses. So back in September, as we said in the press release, we had posted a bond for that and cash surety behind it of $1.6 million US. By the time all the dust had settled, we announced in December of last year that we had settled up the Canadian and US litigation. We were able to recover $200,000-300,000 grand back, but there was a net ultimately loss on that piece of litigation, and it took a hit of $1.6 million during the 2020 year. I guess the one thing I can talk about it, folks, is that will not reoccur in 2021. It's disappointing. It's not new information though. It's information that's been in the marketplace for a number of quarters. But I guess that's out there. And between those two items, it took a very strong EBITDA to a net loss for the 2020 year of about $1.7 million. You can run performance numbers. Quite clearly, we would have had net income if those two items hadn't happened. And from an operational basis, we put in place additional measures related to protecting us against future frauds. That all being said, I'm not sure the pandemic is a recurring theme, or I hope it isn't. And we were bamboozled on that one. Relative to the lawsuit, it was a calculated guess. We were able to raise capital to support it. And if you don't know this, a British-based fund had written a check for about $1 million for us to proceed against Airwatch in this litigation. They were taking a small sliver if we won the case. There was no downside for us. So we had a lot of validation around our position from someone who wrote a check and was willing to pursue this action with us to a number of different law firms. And look, I can't speak negatively to any one legal system, but it sure is interesting that the moment there's a switch on the judge, that the case goes the wrong ways or adversely for us. It's very disappointing, but we're all big boys and we move on. So I'm probably spending too much time talking about matters that aren't core to our business, but did impact the P&L for 2020.
You obviously you write a big check for a legal issue like this, and you're going to have to sort of pay for the hardware that gets stolen. How does that affect your cash balance? Maybe talk a bit about that.
Yeah, so all those things, were funded by the business of its operating cash flow back in between June and September of last year. So before the equity raise happened of $3 million, we were cash flow healthy, and we were able to do the things we wanted to do. And I asked this question, so let me jump ahead. I've answered this question to jump ahead on it, Paul. The money that was raised in December has principally gone towards the acquisition of Data Source Mobility, the deal we did in March of 2021. So the connection, people at times want to connect those dots, not correct. We had funded, again, from the cash in our bank and operating cash flow, the litigation, and dealt with the fraud from it.
Mm-hmm. Okay, gotcha. Perfect. And I think as of the end of, I guess your last reporting period, the end of December, you had a cash position of, I think it was just over $1 million.
1.1 million, and on the other side we show bank debt and seller's notes of about $1.8 million. Those seller notes have terms of, call it, anywhere from a year to 2 years left. So we're in a healthy position. Above and beyond that, we have lines that we can access that in Canadian dollars would create around another $3 million of availability. We are cash flow positive. We had sizable renewals also during the late in the first quarter and into the second quarter of this year. The business just creates cash flow, and we use our own cash flow for growth, investing in the infrastructure, the support, our technologies, etc. So we're in a good position to be very pointed about this. The only reason we would consider raising debt or equity, I guess, would be depending upon the sizable acquisition going forward.
And why don't we talk about the acquisition you just closed, and then maybe the strategy involved in this, because it's not. I mean, there's a strategy or sort of a madness or method to your madness here, so to speak. Maybe explain why you acquired this company and what the plans are.
Yeah, Data Source Mobility was a reseller of rugged devices. Their operations were around Nashville, Tennessee. The area they covered was south to Texas and east into the area that would include Alabama and Georgia, as well as some work in Missouri. We were attracted to them because the nature of their accounts were large public safety accounts from the city of Dallas, the city of Houston, the city of Plano, the city of Frisco, all within Texas. And when you have a relationship with a community that's buying rugged devices for you, there's a reason why they're buying them. All those devices in those communities I mentioned are going either into fire or police vehicles, which gives an opportunity also to sell them license plate recognition technology or incremental rugged devices. And so it is for sure door openers to us as we expand into Texas. We do have some presence in Texas, but we felt this opportunity would accelerate that. They also had another oil field services company as a client in the enterprise space, Spire Energy, that we're pretty excited with. And then lastly, one of the world's largest courier companies, or I'm not sure what they call themselves, logistics courier companies based out of Tennessee. I'll let you figure out who that is. is also a client of theirs. And we see that being strategic, a choice we've made. We acquire businesses that are resellers, that are transactional based at very low multiples with the thesis of, one, it's accretive and it's financially interesting. But two, more importantly, is the things we can bring to the table. DSM didn't have capabilities around install, post-sale support, asset configuration, asset tagging, or engineering services. All those things we bring to the table. So even if we weren't upselling LPR, we're selling additional services around the primary transaction that will create new gross profit dollars for us as a business. So the thesis is to buy key accounts in the public safety and larger enterprise accounts in geographies that we currently have a presence and/or are growing them. And then two, we're acquiring sales reps, people with embedded or deep relationships. And that's important to us. I'm not sure everyone's thought through, and if you have, good on you. But one of the implications of COVID and the global pandemic is that people are a lot more transient with their careers. And what I mean by that is they look at career stops almost like using an entertainment industry terminology, like a gig. And so people are staying shorter, they're stopping shorter, and it's a real burden on the organization. So through acquisition, you can find really strong talent that is committed to what they've done. Obviously, they show the commitment historically and have a strong interest in growing their career now with Route1. That's a smart move for us because the cost of acquisition of talent, the retention and development of them is very high. And I think if you did surveying, one of the things we talked about with the pandemic is businesses are spending more and getting less productivity as a result of the pandemic. And the productivity comment goes to people opting around. And so we're pretty excited about this. I'm giving you a very long answer to a short question, but there is a method to our madness around these types of acquisitions. It's not a consolidation play of VARs. What it is really door openers to deeper, longer relationships that we can deliver outcomes to clients. I think you'll see, Paul, if I move it forward, will we buy additional VARs in the rugged device field? Yes. Will we buy them at similar or lower multiples to gross profit or EBITDA? On average, we're looking at buying things at 2 to 3.5 times. Yep. Annualized numbers, excuse me. But I'm also interested in acquiring additional engineering services and talent. That would be in the access management and other video arenas that will support the work we're doing with larger communities. And I'm also interested in acquiring early stage or broken technologies that we can bring our sales network and power to, as well as our operational excellence to improve or build out the business. So we're going to do some interesting things during 2021. We already have one sizable acquisition under letter of intent. Doesn't mean it's going to close, but we do have that and a number of other discussions in the works. And I think when I started this year, and Paul, when we got to know each other, one of the things I said to you is I think we can double the size of the business. If I'm being very acute with that, I think we can double the size of our GP and EBITDA on a run rate basis by the end of this year, following the model I just explained to you. So I'm excited about it. People say, well, what's that mean around revenue? It's probably $75 to $100 million. I've said that. But let me ask you this question. If I can deliver 5 million of EBITDA off of 50 million versus 75 million of revenue, I'm an advocate of that. I'm an advocate of it because at that base of that EBITDA of 5, there's a lot more recurring revenue and the top line looks a little smaller. I'm okay with that. I'm also okay with less working capital invested in AR, to be frank about it, to generate the same amount of EBITDA. So what we're looking to do, because one of the other comments is, hey, Q4 revenue was down from Q3. Yeah. And that's because effectively here in the US post-Thanksgiving, a lot of procurement slows down on the transaction side. But what you could see on the other side in the granularity that I have access to is a lot of projects related to going on to college campuses, working with larger enterprises that have parking and as well as, law enforcement and installing cameras, doing the services, entering into new long-term contracts. One of the things we're going to do a better job of through the course of 2021 is to profile the post-sales support recurring revenue coming out of LPR. Because to me, it's as important as the SaaS-based model. If I have a contract for 5 years or 3 years with support, and and the way I deliver against that is with my fixed cost base, that's all dropping to the GP or bottom line. So we're going to profile that a little better so people can understand the power of our LPR model, which is not just the transaction, not just the short-term services, it's the longer-term relation and the support contracts in place.
Gotcha. I'm going to dive into a couple of things you said there, maybe get a little clarity. But when you're acquiring, or do you have a sort of valuation criteria around your acquisitions? Is there sort of a set of numbers you want to see? Like, are you buying below 5 times EBITDA? Do you buy between 5 and 7? You know, what
no, I think the key part here, Paul, is that if I'm buying a rugged device player, I'm very much looking at the cash flow generation capability as their profile. I don't want to share my synergies if I don't have to with them. So I'm looking at in or around 3 times their historical numbers on an average last couple of years basis. And if on top of it, if this player was able to grow their business during 2020, during a much tougher window, because if you think about the first half of 2020, almost pre-COVID, the real thing that started here is there's a significant slowdown of manufacturing in China and the Far East, which was their start to COVID, which had a profound impact on rugged device sales through the course of 2020. So if I'm acquiring a player that did well through 2020, has all those metrics, and we can buy them at 3 times, that's a good deal for us.
Mm-hmm. And then the next question around this is, when you acquire a company like this, how long does it take before the staff are trained or able to sell your other products?
Yeah, insightful question. Not that your others questions haven't been good, but that's a good, you nailed that one. Bringing someone in to sell LPR is not like a week of training, watch a video, and go out there and do it. It's going to take them 3 to 6 months. Now, what I would also caution here, Paul, because it's a technical sale, LPR or MobiKey, you have sales engineers with deep embedded institutional and technology knowledge to support a business development officer. So as I look at it, yes, there's a ramp up period. There's also a support network that you can rely upon. But someone starts here and the first 6 months are a climb till we get them. We have a view of what a different types of business development or sales professionals should deliver on a quarterly basis in GP. And to get to that kind of like top number, we don't expect that out of somebody till the third quarter, 3 quarters of them being with us.
Okay. Let's jump back to the numbers a little bit. So you had, I think, a line item, subscription services. It was up 29% year over year. And I mentioned that's really the real SaaS part of the business. It down fractionally, very small amount from Q3. Maybe give us a sense of general trends, or why even is there that little tiny drop? Is there seasonality? What can you tell us?
Well, it's FX. It's foreign exchange, and the strengthening Canadian dollar is a mystery to me. Maybe I'm not the best economist, but it doesn't help us. Almost all our MobiKey sales are in US dollars, and then we have to convert them back. Our second biggest account, or biggest account, is the US Navy, and they're one of the accounts that we bill on a 30-day cycle with. And so FX is real for them. Other accounts bill annually in advance. So it's lumpy when you see that FX improvement or hurt. So for example, the relationship with the Pentagon renews at the end of March, and we'll have a negative impact. I mean, it went from, I think I showed the slide yesterday, 1.4 down to 1.24 or 1.5 as a foreign exchange rate. That hurts us. My job, regardless of the FX rates, is to grow the EBITDA and recurring revenue. But in short windows, if there's a lot of volatility or significant decrease in the exchange rate from an American perspective, that does not hurt us, and it's really hard to address.
Okay, fair enough. It's affecting a lot of companies we're talking to in a similar way. So it's strange to always want a currency that you own to go down, but so be it. Let's jump to MobiKey, or any of the sort of software as a service style part of the business. What can we sort of look forward to? Let's start looking a little bit ahead now rather than looking behind.
So there is, yeah, like Paul, there is, when you hit a global pandemic, I like the simple thing is to say everyone needs to work from home. Why is MobiKey selling millions of subscriptions? Every business out there already had some alternative approach, and most of it was virtual private network or VPN related. And so certain those organizations went through some real crisis where maybe their approach failed and led to immediate sales opportunities. The second element to the pandemic is it was a real life test to everybody's disaster recovery or continuity of operations model, right? Like this was a real life scenario. So we're now in that stage where many states or government agencies or enterprises are starting to come back around into what I would call a more regular operating model and starting to say what worked and didn't work. So on a high level, that provides that secondary opportunity of people now looking at new investments for what may be next coming at us. I think there's a general sense in corporate America and with the government probably more than that, that this type of subject where people have to work from home, I'm not saying a next pandemic, is something that we'll see from time to time. And so we need to be better prepared for it. We have a number of opportunities with, again, the US federal government that for us is the low-hanging fruit that we hope to close on during the course of 2021. That will increase the subscriber base as well as the monthly or quarterly recurring number value. The same time, what's going on in the MobiKey world for us is Microsoft, as many people know, have rolled out a technology called Office 365. And a number of government agencies here in the US have made the decision to put their data in the cloud. And by doing so, private cloud is what I'm speaking to, but by doing so, Office 365 then delivers the applications, whether that's Excel or Word or SharePoint, whatever that is for a user. And their computer can still be a physical machine, but where many organizations are moving to are a virtual machine. And then you say, well, then what's MobiKey's role in that? Well, MobiKey plays a critical role on the front end of that. It authenticates that Paul Andreola is Paul Andreola, which is a critical piece as it pertains to access and entitlements. And then the second part is there has to be connectivity between the mobile device and that virtual machine. And so we play that role of securely delivering a protocol so that effectively two assets can talk. And that provides an opportunity for us. So I'm giving you two things we're dealing with real time. One, the second order of what happened during the pandemic with working from home. And two, a move that started 5 years ago, but is accelerated now, moving the desktop to the cloud and leveraging Microsoft for the deliverance of applications. And so I think there's a reasonable opportunity here that we will see MobiKey grow. There is a role for us in this mix. It is a little different than the pitch I first drafted 10 years ago or 8 years ago on MobiKey, because at that time, everybody had a desktop, a physical one, excuse me. And now we're looking at something different. And I'm very comfortable that MobiKey has a role for a lot of years to come in this area. Our job is to effectively communicate our value proposition in the architectural model leveraging Office 365. And that's what we've been moving on here. I could go into many more details around specific MobiKey accounts, but we do expect growth out of that technology during the course of this fiscal year.
Great. Are you doing anything different? Are you doing more of anything as far as selling MobiKey? Is anything changed in how you're addressing that?
Yeah, a lot more demands. If I think all the way back to 9/11, one of the outcomes of that, and it's not a political statement, is decentralization was a way of securing organizations. And the federal government here in the US went to many, many silos. And so the pandemic and the opportunities related to it means there's a lot of sales pitches, because one group of the Army says they want to invest in MobiKey doesn't mean, excuse me, any one other group is going to follow it. If another group does, they can leverage the accreditation and authorizations to use the technology. But from an intensity and time to sell, there's work to do. And because we can't travel to certain government sites because they're still shut down, it's just a more tedious, longer process with selling. Where maybe historically I could have gone to a particular location and had 5 or 6 meetings pretty quickly in person and nailed things off. It's a little different now. So look, it's just a different environment to sell, but fundamentally what's different today about MobiKey is talking specifically about its role in an Office 365 environment.
Mm-hmm. Is there anything else that sort of, let's say anything else that's changed since we spoke last? I think we last spoke about 4 or 5 months ago. Are there new opportunities? Are there new challenges? What can you tell us that's new?
Paul, it's funny. When we report numbers, we're always many months behind where you currently stand, and it's the nature of the beast. I look at this here's where we are. We came into this year thinking state, local, federal budgets are going to be cut back. This could be an interesting year around LPR investments. To date, way more robust than expected. So way more activity, which means hiring more people. We continue to grow and get bigger, and we're moving as quickly as we can in that type of environment. As California is on the cusp of full opening up, we're going to be busy. That's exciting. 2, as we continue to work with the underlying technology partner, Genetec, for the license plate recognition technology, you should expect this year very shortly, maybe even Q2, come out with an application, software application that we've developed, leveraging their software development kit that provides greater functionality to LPR for the law enforcement arena. That is the first time we will have done that. We hinted about that last year when we got to know you, the things we can do with our software engineering team. We have a direct request from law enforcement. I don't want to tip it too much, but when we come out with it, it'll be very obvious why we've done it and how we're going to create revenue and GP out of it. So that to me is a bit of a change. We've advanced that, or we're getting very close to closure on the first initiative. I would say that those generally, it's only been a few months since we spoke last, but it's just the rapid acceleration of the use of video at the state and local level and the opportunity that's there for us if we can jump into it. So we're pretty excited about that.
So you've actually answered another question I was going to ask, and it's just simply that, you're taking on these other hardware sort of companies and products, and how much software can you deliver to those? Or are there any software offerings outside of what you described? Are you looking at other software offerings?
It's interesting. Most of these agencies require data storage, data analytics. I'm using larger concepts, but I think you'll appreciate what I'm saying. And then there's some small communities that just can't afford their IT demands. And so it provides us an opportunity to look to bundle the services with the actual outcome and get quite embedded with some smaller communities. Not every state is doing as well as other states. Here in Arizona, they had a $2 billion plus budget surplus during the last year, which is unbelievable, and looking at tax decreases here. But not every state's in that position, and you literally have communities that are underfunded around their IT needs. So to your point, Paul, it's smart that we leverage our engineering capabilities with our software to bundle up an offering that puts us in with a agency for many, many quarters.
Mm-hmm. And I know you've expressed it in certain ways, but let's refocus on what are you the most excited about going forward in terms of where your best growth opportunities are?
Well, look, the state of California is, some say the 7th, others say the 5th largest economy in the world. We're doing what we're doing without that being fully open. We won last June in the middle of COVID, a very large contract in the state that exclusively allows us to sell LPR to any government agency in the state. What's happened since that point in time is we've been waiting for the state's technical group and lead client, which is California Highway Patrol, to say we're green, we're good to go with the technology in all different scenarios, whether it's mountainous and so higher and lower frequency ranges for CBs. Does the LPR technology work? We're right on the 1 yard line around completing that and getting the lead order. So what's the big opportunity that hasn't been scratched over the last 6 months? Is that one. I see significant upside. It's a massive economy, massive opportunity. We'll be out promoting and marketing that contract vehicle, selling into it. So I see that as a significant opportunity for us. That's one. Two is the second order of COVID with the federal government and working with groups to deliver true functionality for working from home. The National Guard, whether it's Air or Army or others, they were underserved pre-COVID, provides significant limitations in the communication for guardsmen and guardswomen when COVID hit. And I think, as they call it, them day soldier on the Army side, I think there's a real opportunity in that arena for us, and our job is to get it done and grow off of that. The Navy, which is another key constituent for us on the MobiKey side, recently has switched from perspective to Leidos as their prime for all their IT services and technologies. We switch over with Leidos as June 1st. And we're excited about that because Perspecta historically had some competitive offerings that we had to grow MobiKey users inside the Navy on our own. And Leidos is so far taken a very positive, supportive role. And I think, as we've talked about, we just recently refreshed our infrastructure there, and I'm expecting growth with that account on the MobiKey side in Q3 and Q4. So, I'm not giving a straight answer. What I am saying, there's multiple irons in the fire that I think could create a big win for us. Like ultimately, you want one of these things to pop us. I get it. I do too. And I look at diversification around that. And we have so many good things there. We got a few of those across the finish line, and we're going to be big winners.
I'm going to take this opportunity to remind everybody, if you've got any questions you want me to ask Tony, please use the chat function. We do have a number of questions, but it looks like most of them either you've already answered in your presentation or through some of the questions I've asked. Talked about it a little bit, but any other headwinds you see for the business? Any challenges that we should be aware of?
I think the only thing is, we've talked about it for a little bit, is the Biden administration, again, not making a political comment. When there's a White House change or administration change, where do they want to invest the dollars? I'm not saying they're anti-cybersecurity or anti-technology, but you always worry. The Trump administration put money into data security and cybersecurity. Will that continue as they look for cost savings to fund potential other initiatives? You just had to listen to the president's address a couple of days ago and where he wants to invest money. Knowing the tax base isn't going to grow by trillions of dollars a year, you know that there's going to be cuts. So we saw that under the Obama administration. So I always hold my breath, to be honest with you, a little bit, as it pertains to cybersecurity investment and where we fit in that. So I wouldn't call it a headwind. It's just be aware of the fact that when you deal with government and the political aspect of it, you have to manage through environments where it can be pro or anti cybersecurity.
Mm-hmm. We saw the share price get hit the last 48 hours, like you said. What do you think the market is getting wrong right now about the business?
Oh, well, look, so Paul, when we raised capital back in November, December, and I met you, if we had a tape recorder, I would say to you, I thought at 85 cents, that's underpricing us. And look, every CEO says things like that. But the truth is, I don't think the market fully gets our model. I thought 85 was the low end of the range for the value. Since that point in time, we've used the money to buy more gross profit and EBITDA, so there's more good stuff. And we're down at 64 cents. I think there's some sellers that probably didn't understand the things below the line or hadn't read the information that was put out there in Q2, Q3, and Q4, and reacted to that. I'm disappointed, but within 3 weeks or thereabouts, we'll have Q1 out, and it won't have that noise, and it will be a good quarter. And so we'll work from there. As you know, if I lived and died by the share price, I wouldn't be a very effective operational leader. The truth is, I'm disappointed with it. I'm listening to Trevor say a $24 million value. Okay. Our NCIB was active yesterday. I know our chairman bought stock in the market. I'm blacked out right now. And it's difficult for me to find a window where I can buy, to be blunt about it. So people are asking why I'm not buying. It's because of that. I think, people will figure out the values on their own. This is 20-25% below where we did the offering, and that's where it is. I think it's a hell of an opportunity.
And it's a good thing you reminded me that you guys do have an NCIB that's active, and obviously, like you said, just has been buying. So good reminder there. Again, going forward, what are the key metrics that investors really should be honing in on to see if you're sort of successful in your strategy right now?
Yeah, look, the one operational metric I talk a lot about is the number of gross profit dollars per $1 invested in sales and marketing. You want to see, like every quarter, there could be obviously some variability, but you're looking for that growth where we've gone from 2.4 GP dollars to 1 sales and marketing dollar, going back, I think, 7 or 8 quarters, to now where we are. We finished Q4 about 3.3. And look, any one quarter could be up or down against that number, but I would expect us by the end of the year to be going towards 3.5, 3.7 into that territory. And I really think that's a key part of this. It's looking for us to do a continually improving job for every dollar that we put to work in sales and marketing. That's one. And two, I would encourage investors to understand that, and Paul, I think you get this because you invest in small cap companies, but there is no simple way to hire people and immediately have them be the most effective sales rep. So that might mean in a period. So let me back up. I said yesterday, if people listen to the call, our goal is to take this current model without any new acquisition from, what's it, 700, 750 a quarter of EBITDA towards $1 million. That's the goal to get to and exit the year on a running level there or beyond. If we're to get there, we need to continue to invest in resources and infrastructure. Those investments are going to be lumpy at times with how we go. Doesn't mean I need more money, but could 750 in a quarter be 700 or 650? So the investments are there. Could we see an 850 quarter come back to 800 on the way to $1 million? I'm not at all giving a forward-looking statement. I'm talking about theory here. And the answer is yes. It was a really nice, convenient staircase, and the nature of business and how quickly we're trying to move in an economy that's ridiculously hot for talent. There will be some lumpiness to get to where we're going, but I thought I was clear yesterday that we expect this mix of business to be able to generate more than $1 million a quarter EBITDA without any further acquisition.
We've got a question here that I know we've answered, but I want to ask it again just to really clarify for everybody. But it says it looks like the company might need more cash coming soon. Are there near-term plans for another raise with or without an acquisition?
So I guess if I was talking to somebody one-on-one and not trying to be rude or flippant, I'd say, why do you feel that? Because I'm not sure there's any metric on our balance sheet or in our operating results. Again, the numbers booked for the fraud and for the lawsuit issues were all pre the end of Q3. And we didn't need money at the time of the raise. We raised it, principally supporting the acquisition. We don't need money now. If we want to do larger acquisitions, yeah, there's a limit to what the current balance sheet can deliver. But my first goal for the next deal is putting together a bigger senior credit facility, to be blunt about that. I hate dilution. I went 10 years between the equity raise, right, in the marketplace. And my next goal is, before we consider further equity to do a deal, is what can we raise in debt that's appropriate for the size of company and cash flow that we have.
Perfect. I just wanted to make sure that was clarified. Okay, so that's an interesting question. How do you see the global chip shortage affecting you this year?
You know, it's interesting. Look, the chips are part of the transactional part of a business, for sure. And if you would ask me this question 60 days ago, I probably would have said not a lot. The guidance we were getting from GTAC and Panasonic was maybe we would see some delays of 4 to 6 weeks, 6 to 8 weeks, and that would then come back to normal terms in Q4. Based off our recent meetings I've had with business leaders of OEMs, I think we'll see that be 6 to 12 weeks and continue through Q4 and start becoming more normal in Q1. It was I think the other part that isn't, we talk about chips. Part of the chip shortage issue is a water shortage issue in Taiwan too, right? This isn't just regain supply demand back to normal. This is the fact that the production in those areas requires certain natural resources and inputs to be able to produce more. And water is a key part of that. And I'm hearing that very clearly. And so, look, I'm not over there. I'm not in the middle of it. But we're managing our business assuming that the chip shortage is delaying the average delivery time from 4 to 6 weeks to 6 to 8. And the numbers we'll have, for sure, will have be negatively impacted in that area. But then isn't that my job and responsibility to push more on other areas of the business that candidly higher margin, like LPR, and focus in that arena versus trying to get those big lumpy one-time orders for rugged devices.
Gotcha. Well, you know what, we've come to basically the bottom of the question list here. I've run out of questions. Looks like we're not getting many more from the listeners. Tony, I'll give you a chance to sort of have, a few minutes to either give a parting message or just, re-emphasize any message you want to get out to our listeners today.
Well, look, I guess first of all, Paul, it's rare to have an opportunity like this one with you, where there's insightful questions, you're representing feelings and sentiments and concerns, and you put them out there and you give me an opportunity to respond to them. And I thank you for that. I don't have anything really new to say. I'll be upfront with you. I was shocked yesterday. The business hasn't changed. If you bought into the thesis in November or December, boy, attractive entry point. I feel very confident in what we're going to be able to deliver. And I think, proof will be in the pudding here, but nothing fundamentally has changed with the business model. I think if anything, as I said a few minutes ago, some of the headwinds that we thought might be there around government budget constraints at the state and local level aren't there. And I think the model still sticks and is very effective. So look, to those who have listened to me for an hour today, I really appreciate your tolerance and interest. And I hope you stick with us here because we're excited about the future.
Tony, listen, thanks very much. It's been an interesting start to the year for a whole bunch of different reasons. You guys have obviously been very busy on a bunch of different fronts. Always appreciate the time you take to explain everything for us. We've been speaking with Tony Busseri, CEO of Route1 Incorporated. Tony, until we catch up next time, I want to thank you again and safe travels.
Thank you. Have a good day, everyone.
Okay.